Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Your equity market just a little bit softer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, Yellen telling Bloomberg, I don't see a recession, as the Fed goes quiet before next week's decision, and the dollar is on its worst streak of the year. We begin with the big issue, embracing a soft landing.
You cannot get in the way right now of the soft landing narrative.
We see a soft landing.
Soft landing.
Soft landing.
The consensus view is for a soft landing.
The economy itself is strong and robust.
The data we've gotten recently,
better jobs numbers, better CPI, better PPI, better earnings.
It's all been about a soft landing narrative.
Which gives the Fed a little bit more leeway.
We are definitely in a good window for inflation data.
Over-tightening risk by the Fed has been removed.
There's nothing automatic about a recession.
I just don't think you're going to get a pullback.
We are, shall we say, cautiously optimistic.
The odds of a soft landing continue to increase.
Still think it's going to be tough for the Fed to achieve it.
There's just no room for error.
He could be the wizard of the economy in Wall Street if he can truly soft land this.
Joining us now to discuss, John Hancock's Matt Miskin, Colin Martin of Charles Schwab. To the two of you, thanks for being with us. Going into the opening bell about 29 minutes away. Colin, first to you, just to pick up on the language that Mohammed was using then from Friday's session, Friday's conversation on this program. Is the soft landing narrative something you want to fight?
Well, we don't want to fight it because that would be a good thing overall. We don't really want to see a recession. We don't want to see growth slow too much. Now, we acknowledge that things are clearly looking a lot better now than we thought they would when we were coming into the year. But we're not convinced that we will ultimately see a soft landing. It seems like the recession timeline, if it ever does come, seems to keep getting pushed back a little bit. But we're concerned that we know that monetary policy does act with long and variable lags. And we're also concerned that the Fed might need to either go a little bit higher or maybe hold for a little bit longer to make sure that those inflationary pressures don't continue to bubble under the surface. Because at the end of the day, we're seeing sentiment indicators improve. We're seeing wages on an after or adjusted for inflation basis look a little bit better because we've seen inflation come down. But at the end of the day, the Fed doesn't want to see consumers continue to spend if things are looking good or if the stock market's going up. So we think that maybe the timeline for slower growth or a potential recession has been pushed back. But we're not necessarily sure that a soft landing is the ultimate outcome.
Colin, I know a man who might agree with you. He works at Citi. It's Andrew Hollenhorst. He published this morning. Soft landing optimism is premature. He says this: tight labour markets, elevated wages, upside risk to shelter and other services inflation mean we do not share this optimism. He goes on to say, absent a tightening of financial conditions, inflation may reaccelerate in early 2024. Now, Matt Miskin, I'd love your view on that. Which one is it? Should we fully embrace this disinflation playbook, or do you listen to Andrew Hollenhorst and say, hold up, there's more to come?
Well, I don't think that inflation is even the biggest risk anymore. You know, it's amazing. We're myopically focused on inflation. That's all the market seems to care about. And I do welcome disinflation. I mean, there's nothing better than the smell of disinflation in the morning. And you hear about car prices being slashed this morning, and it's like, that's great. But why, when car prices or any of these prices are coming down, what does that mean? That means revenue growth is coming down. And you're also hearing about wages still being elevated. So that's margin compression. What are businesses going to do with margin compression? They're going to have to cut costs. And overall, inflation coming down is going to mean weaker nominal growth. Global growth is slowing right now. And U.S. growth, while it's holding up the best in our view, is even slowing as well. So we think that the number one focus of inflation is actually misguided. It should be on growth trends, and growth trends are decelerating globally. That's going to be the biggest risk. And that actually to us means that Treasury yields still have more work to do in terms of repricing.
And Matt, I'd also assume that based on what you just told me, you don't see much support for equities.
It's hard. It's just tapped out. The multiple has gone from 16 times at the beginning of the year to 19 times now. It's all sentiment. It's amazing seeing that montage, John, because I guess I'm out of the loop as of late at how much now the soft landing is the number one narrative. Well, it's priced in. if high yield spreads are 379, the lowest year to date, the VIX is at the lowest year to date, and the multiple has gone up, the multiple has basically driven all the return in the market year to date, meaning it's all been sentiment driven. To us, this is pricing in a soft landing, if not better. So if you want to say, hey, what if the consensus narrative doesn't play out? You can get protection right now pretty cheap. Protection is on sale in portfolios, and that's actually what we would look to add to incrementally here, given the pricing in the market.
So where on the curve are you thinking? Is that put your cash in a 10-year yield, 10-year treasury bond? What are you thinking about?
Yeah, I mean, right now we're just intermediate around the 10-year. You know, we're trading at 89 cents on the dollar on investment grade, high quality bonds. MBS securitized right now has just gotten crushed in the last year. The yields are about 5% on AAA paper. We're just seeing great yields, 5 to 6% on investment grade bonds in the intermediate part of the curve. We'll look for the 30-year, even longer duration, probably by the end of the year. For now, we're just getting paid to be in the intermediate. You're getting a lot of bang for your buck there. That's where we'd hold in.
It's such a strange moment, Colin. We've got people talking about soft landings and high yield spreads are at the tights for the year, south of 380. Then you've got people talking about recession, saying buy the 10-year. I've heard the same thing from JP Morgan Asset Management and Kelsey Berra this morning. The 10-year's at 380. Is there some tension there, Colin, that we need to resolve?
Well, we're clearly seeing conflicting signals here, and I'm in agreement with Matt where I watched that montage and I didn't realize that the soft landing appeared to be the #1 narrative right now. We are seeing mixed signals. Now, if you look at the performance of high yield this year, it's been one of the best fixed income asset classes out there. Based on our outlook, we're a little bit surprised. But if you look at basically the spectrum of investments this year, especially how strong stocks have done, you can't be too surprised that high yield bonds have done so well. When you look at that spread level of 3.8% or less, that in and of itself is concerning for us. It's just not much spread given what we think is still a disappointing and tough economic outlook. And when you can get such high yields without taking much risk elsewhere. Now, all the things that we've been concerned with are still present right now, which is what, a deteriorating or slightly negative economic outlook, tightening bank lending standards, and the inverted yield curve, and what sort of message is that telling us? So everything that we've been concerned with is still there, and if anything, the declining level of spreads makes us even a little bit more cautious now, and we continue to focus on quality.
More bank earnings coming tomorrow morning with the likes of Bank of America and Morgan Stanley still to come. Goldman Sachs reporting on Wednesday. The calendar for the economic data so far this week, pretty light. US retail sales tomorrow morning. The Fed, of course, in a quiet period. Mike McKee on top of all of that. He joins us now. Morning, Mike.
Good morning, John. Well, we start off with the New York Fed's contribution, manufacturing in the New York region, and it does decline a little bit to 1.1, but we did see new orders rise, employment rise, and prices fall, so that is good news. Tomorrow, you mentioned retail sales. They're expected to be up, while industrial production is thought flat. We do get a speech from the Fed's vice chair, Michael Barr, but it's on fair lending, so it won't have anything to do with monetary policy, so you can probably ignore that unless you're in the lending business. Housing starts, jobless claims, those are going to be big numbers because housing has been very, very strong and jobless claims have been weak. Philly Fed, we'll see what they have to say. Existing home sales, and, people are not selling their houses. They don't want to walk away from their mortgages. But I would like to introduce your guest today to a couple of new indexes. Matt Mishkin mentioned the need to see growth. Well, here's the Bloomberg surprise indexes for growth and inflation. They've come up with a new index for both that kind of separates the two out. And you can see the white line there is growth. And according to Bloomberg economics analysts, it's very strong right now, pointing to a much stronger than anticipated economy. While you look at the blue line, inflation still going down as expected. So the prognosis is good going forward, at least from this new data that Bloomberg is putting out. But the question still is, what's the Fed going to do? We've gotten the sorting hat together and looked at where we are in terms of who's thinking what. And for the most part, people are thinking we're going to see a rate increase, and that's what's priced into the markets. The only difference with the sorting hat this time is Jim Bullard. He's not going to participate. He'll be on the Fed until or at least at the St. Louis Fed till the middle of August while he helps transition there. But everybody else except Raphael Bostic at this point is a yes or a maybe from what we've heard since the beginning of the month. So it looks like we get at least one more rate increase, John, and then it will be the data to take over. But if the data continue to be strong, you could still price in September or November.
Mike, thank you, sir. Colin Martin, is it one and done or more to come?
Right now, we think it's one and done. We think they've done so much. We need to see how long it takes to see what this really means for the broad economy. But as Mike just mentioned, things are still looking pretty good. I mean, the economy continues to surprise to the upside. So if we see more upside surprises, it's possible. But at this stage, our base case is one and done.
Matt, it's hard to fight, isn't it? Upside surprises for growth, downside surprises for inflation.
Yeah, I mean, that's Goldilocks, right? And I love the chart, Mike. I appreciate it. The only thing I would say right now is I believe that is a U.S. chart. And U.S. Economic Surprise Index is going up, or has been going up, and that is great. The rest of the world, though, is another story. The Eurozone Economic Surprise Index is like at a negative 100. I think they had to change the scale of the chart because it fell off so bad. China's data continues to come in worse than expected. So right now, the U.S. is holding up the global economy with that economic surprise index, but it's a global economy. And we think that is coming down. The other thing I would consider with that chart, I love charts, so I'm just going to go off on a little bit of a rant on charts. But there's lagging indicators in there, and there's leading indicators. The survey data, the more leading indicators have been falling more so than the coincident and lagging data. The lagging data is holding up great, and a lot of that's employment or wage data or some of the more things that take time to reverse lower. So when we look at the leading indicators, though, that's the data that continues to show weakness, the surveys, the manufacturing data, so on and so forth. And that's telling you where the puck's going, and we think that surprise index is going to be rolling over as well.
Matt, since you love it so much, I'll give you some more time in just a moment. We'll talk about growth in China, in Europe, and why on earth this dollar's selling off and not rallying. Given everything you've just said, Matt Miskin, Colin Martin sticking with us. Let's get you some movers going into the opening bell, about 20 minutes away. Here's Abby.
Well, John, with futures just about flat here, we do have some leaders to take a look at, starting out with the shares of Activision, which are popping higher on, it looks like the deal is game on. The FTC lost its appeal to block the $69 billion deal with Microsoft. That's about $95 per share, so you can see Activision pretty close to that. Investors weighing in, saying it is very, very, very likely to happen. Tesla up 2%. Their first Cybertruck rolled off the production line at their Giga, Texas plant. Both investors and analysts seem very optimistic that they will launch this vehicle in the late third quarter. And then NVIDIA, Citi has raised their price target to $520 from $420, saying that the risk to reward is positive on accelerating year-over-year data center sales. Not even a mention of AI, but we do have that price target raised significantly, John.
What a run for this stock this year. Abby, thank you. More from Abby around the opening bell. Coming up, Secretary Yellen says the U.S. is on track for a soft landing.
Slow growth in China can have some negative spillovers. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think that we're on a good path to bringing inflation down.
The Treasury Secretary, Janet Yellen, in conversation with Bloomberg's Anne-Marie. We'll catch up with AMH next.
Growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think that we're on a good path to bringing inflation down. The most recent inflation data were quite encouraging.
An exclusive conversation with Secretary Janet Yellen speaking from the G20 finance ministers meeting. Global financial leaders gathering in India, discussing global trade, debt relief and more against the backdrop of divisions over the Ukraine war and US-China geopolitical tensions. Bloomberg's Anne-Marie joins us now for more. Hey, Anne-Marie.
Hey, John. Well, the real takeaway from the Treasury Secretary is that she is not expecting a U.S. recession. And although we do have this slowing of momentum of growth in China, and she said that's really important for especially Asian countries as they develop, and you could see spillover effects in the United States, it does sound like her base case is that the U.S. will avoid a recession, will be a soft landing. But you have to imagine difficult time for the Treasury Secretary as she is dealing with her Chinese counterparts. She's just off her trip from Beijing. She's in India. She's dealing with some of their deputies over in India. And we're all waiting in the United States for potentially this executive order. And when I asked her about this, she really tried to hammer home that this is going to be narrow in scope. And this line really stuck out to me. She said prohibitions with these would not be broad controls that would affect U.S. investment broadly in China or, in my opinion, have a fundamental impact on affecting the investment climate for China. So, Jonathan, when it comes to this executive order, it does seem like she's trying to quell down some concerns that her Chinese counterparts maybe had about further escalation when it comes to the economic front between Washington and Beijing.
You've talked about division between the United States and China. Let's talk about potential division within the administration. MH, how is the Treasury Secretary balancing her economic objectives with national security concerns elsewhere in Washington?
Well, I think this comes down to the heart of the matter is what we're talking about right now, the outbound investment. It's supposed to be done, Jenny Leonard and I reported, the end of July. Potentially it slips. I'm told that it will be done this summer. But this is something that the president's national security advisor, Jake Sullivan, called for 2 years ago, almost to the date. It's more than 2 years. It was July of 2021 in this speech he talked about. And it took the administration 2 years. They were obviously dealing with what businesses want to see in terms of their relationship on the economic front with China and in terms of the national security concerns. So when you talk about the national security concerns, the secretary has made it very clear. She gave this China speech recently about how that is paramount, even when it comes ahead of what could be beneficial for the United States. And that leads to another topic we discussed, and that is tariffs. And she said that review is still underway. And she said China just hasn't fixed the trade irregularities when it comes to tariffs, which is why the Trump-era tariffs under the Biden administration are still in place. This was a big debate, Jonathan, remember, when inflation was raging on whether or not they would lift those tariffs, potentially give a little bit more breathing room for the consumer. And in the end, they opted not to. And it's going to be much harder to even consider any sort of lift or maybe de-escalation. The Treasury Secretary says they're trying to find areas of de-escalation ahead of the 2024 presidential election, because at that point, the Biden administration needs to talk and look tough on China when every other Republican candidate is going to come out really wanting to take a swing at Beijing.
MH, brilliant conversation. Great work as always. Bloomberg's Anne-Marie Jourdain down in Washington, D.C. in conversation with U.S. Treasury Secretary Janet Yellen over in India. I suggest you all take a deeper look at that interview if you have a little bit of time a little bit later. You can find it on Bloomberg.com and on the Bloomberg terminal if you're a subscriber. Overnight, we had some data out of China. Worse than expected. Listen to this. Citi cut its forecast on growth in China. Morgan Stanley did the same. So did JP Morgan. SocGen went to 5% from 5.5% and wrote this. This can only be achievable if the government continues to step up easing measures. Matt Miskin, Colin Martin still with us. Colin, your base case for stimulus out of China, what is it now?
Well, to be honest, John, we focus more on the fixed income side, more domestically here. But when we look at China, what it means for our markets in the global economy is what is that long-term growth outlook? And we're going to see there and maybe what it means for the dollar. But if growth is slowing, that can trickle into many other global economies, and that can have impacts on the dollar. And if we talk about the dollar, you see, changing interest rate differentials based on what the Fed's doing and what other central banks are doing. But then you also have the counter-cyclical aspect based on what growth rates are. So we're looking really, what is that growth outlook there? What does it mean either overseas or abroad? And what will that mean for the value of the dollar and how it impacts, monetary policy going forward?
That outlook has got worse, not better, that's for sure. Mislav Matejka of JP Morgan running this morning. The region is sliding back into deflation, and the property market will likely need a much more aggressive policy support to rebound sustainably. Given past excesses, we stay cautious on China. Matt, we mentioned this, what's happening abroad. Growth in China is disappointed. Germany's in recession. Yet this euro's stronger, this dollar's weaker. Matt, can you help us understand that?
I feel like I'm in the movie Big, where he's sitting there and he's like, I don't get it. I don't get it. I don't understand why the dollar is weakening so much on this, other than inflation's down. It's almost like algorithmic trading or machine learning or like artificial intelligence, where wherever you hear lower inflation, you just sell the dollar. Like, that's just the trade. And last week it came in huge, down 2.5%. But if you looked at the macro data, the U.S. data held up well, NFIB, initial jobless claims down. But then you had the Germans missed, the Centex missed, industrial protection missed. In China, exports and imports missed. Even in Japan, machine tool orders missed. And yet the US dollar was sold off. And even interest rate differentials don't seem to matter much. As the 10-year is actually staying elevated and European yields are coming down a bit, the Euro USD is still staying strong. So for us, this is basically everything's focused on inflation. It's missing the growth story here that is really actually going to be a huge impact in the back half of this year. We actually are relatively positive on the dollar. I get it. It's sold off. I get it. It's all part of the same trade of risk on. Dollar down, everything up has been the cross correlation, cross asset. But in time, we think that the speculative run in some of these pockets of the market is going to reverse, and the dollar actually could get a bid in the second half.
I sense you want to fade it all. Matt, I can hear you. But you've also heard other people say the following. It's time to get out of what's happening in US tech. It's time to see this market broaden out, this rally broaden, maybe back to Europe. Again, let's take a second look at some of the cyclicals there. Matt, what's your message for them this morning?
So earnings out of Europe thus far, I mean, we got Richemont, we had BASF out of European cyclicals. They both got it down and had organic revenue decline. In the US, it's still holding up okay. We like US quality over cyclicals abroad. That's been our positioning, and to us, that is the lowest risk out of the options in the equity universe. We do try to have a valuation lens. We're looking a little bit more mid-cap in the U.S. where you can drop the multiple pretty significantly. But overall, we think the U.S. is the highest quality market in a late cycle environment. That's where you want to hide out.
Richemont down 9% in Swiss trading. Matt, thank you, sir. Matt Miskin, Colin Martin. To the two of you, thank you. Equities a little softer with negative 0.05% on the S&P. The opening bell 7 minutes away. Coming up, the morning calls, and later, Joanne Feeney of Advisors Capital Management joins us around the opening bell ahead of earnings from Bank of America and Morgan Stanley tomorrow. Then it's on to Goldman Sachs on Wednesday. We're coming off the best week of gains on the S&P 500 and the Nasdaq in about a month. We're pretty much unchanged right now on the S&P, slightly positive on the Nasdaq. That's the price action. Let's get you some morning calls. Citi downgrading AT&T to neutral, expecting the industry's historical use of lead cabling to remain an overhang. Goldman upgrading Yelp to buy, pointing to improving digital advertising trends and stabilizing margins. And finally, Morgan Stanley raising its Apple price target to $220, seeing better growth coming out of India. We're positive there by 0.4%. Coming up, investors gearing up for a busy week of earnings. More from the big banks, plus big tech results on deck. That conversation coming up very shortly with Joanne Feeney of Advisors Capital Management. Your opening bell just around the corner. Let's get your trading week started. Live from New York City this morning. Good morning to you all. Your equity market unchanged on the S&P 500. Just missed out on a clean sweep on Friday. Gains Monday through Thursday. Friday slightly negative by 0.1%. Down on the session, but up nicely on the week. There's the opening bell this Monday morning. Switch at the board and get to the bond market. Last week, Treasuries rallying too. Down about 20 basis points across the 2-year and the 10-year. This morning, we're down about 2 on a 10-year to 381.66. In the FX market, let's sit on this for a second. The euro, 7 days of euro strength against the dollar. Let's see if we make it 8. We're talking about a run we haven't seen since the summer of 2020. Just in the last 10 minutes or so, turning slightly negative by 0.05%. The euro against the dollar right now, 112.22. In the commodity market, we're down 1 full percentage point and some, down 1.1% to $74 and about 60 cents. About 30 seconds into the session, we are positive here by 0.1% on the S&P. On the Nasdaq on my screen, up by, let's call it 0.3%. Two stocks to watch at the open, Microsoft and Activision. A U.S. appeals court denied the FTC's bid to pause their $69 billion merger. Microsoft saying, quote, "This brings us another step closer to the finish line. Abby has more. Hey, Abby.
Hey, John. And yes, it seems as though most legal experts agree with that opinion. And Activision now at its highest level since July of 2021. This deal first announced, of course, back in January of 2022. It's been stuck in this regulatory conundrum for quite some time. Last week, of course, a lower court said that the FTC couldn't block the deal. Activision soared at that point. The assumption was it could go forward, but the FTC did try to appeal that decision. But the higher court, the appeals court, sticking with the lower decision. At the end of the day, it comes down to whether or not the FTC can prove whether or not a deal between Microsoft and Activision harms consumers. It's thought that they don't have that proof. So that's the reason folks think that the $69 billion deal will go through. That's about $95 per share. Activision is around that level. Again, the highest it's been since this deal was announced, suggesting it's likely. Now, there is one last hurdle. That is, of course, in the UK, but we have headlines coming through right now suggesting that all parties are trying to work out some sort of settlement. Even if they don't, John, it's thought that the UK will let the deal go through and then they'll figure out the various pieces. But this stock, Activision, now up about 41% since, again, the deal was announced in January of 2022. It's going to be interesting to see when it closes and if there are future legal battles around it. But most, again, think the deal is going to happen.
Both of those stocks just about positive this morning. Abby, thank you. I want to turn to the automakers just briefly. Tesla moving higher for a fifth day after unveiling its new Cybertruck in Texas. Elon Musk warning, quote, it's going to be hard to make the cost affordable given the new method of manufacturing. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Tesla shares up 2.5%, rising for a fifth straight session and trading at their highest level since mid-September. This is 2 years behind schedule. I'll never forget being in Los Angeles for the unveiling of the Cybertruck. You know the images, the metal ball against the window and it's smashing. And the plan at that time was to start production within 2 years. Well, it's kind of almost 4 years down the road. Deutsche Bank forecasts that Tesla will ship around 2,000 units of the Cybertruck this year. But in the scheme of things, they're also forecasting that overall Tesla will ship 1.78 million units. So it's a fraction of what's happening. It's a really competitive space when it comes to the pickup, especially here in North America. You'll be familiar with the results of our MLive Pulse survey, John, where 53.7% of respondents are telling Bloomberg that the biggest risk for Tesla is its rivals. Think about Rivian, that has been an early mover into the battery electric pickup space. And then the other news out in the market this morning that Ford has cut the price of the F-150 Lightning, in some cases by as much as 17%, as it expands its production capacity and finds lower cost materials. One other final piece of news that may be supporting the stock that is now 2.8% higher in Tesla's case. BYD was out with prelim results late Friday, I believe. Encouraging signs in the Chinese market in particular right now around demand for EVs. And of course, BYD, a direct peer and competitor of Tesla.
And I'm going to catch up with Katie on Ford in just a moment. But let's stay on Tesla if we can. I remember the unveiling. We all do. I laughed at the design at the time, more for me, because the demand, I'm told, is through the roof. Can you tell me about the order book for this model?
Yeah, I was standing next to a Tesla executive the moment it came on stage, and I looked over my shoulder and was like, is this real? Is this really happening? And it was real. The order book was strong, right? Loads of pre-orders. At some point, they stopped taking the pre-order. But here's the thing. The original plan was to produce 3 variants with varying range and number of motors. What's not clear, due to the complexity that Musk cited in that quote you put up, John, is whether they start with a high price point and do a slow rollout with cheaper versions coming later, which is kind of the classic EV rollout formula. But there's demand there, and like all things, a lot of that demand comes from Tesla's core following, its core audience.
Ed, thank you, sir. The stock is up by, let's call it 3% this morning. Dan Ives of Wedbush reiterates his outperform rating on the name ahead of Wednesday's earnings. He writes this: aggressive price cuts were a near-term pain for long-term gains, putting an iron fence around its installed base and gaining new EV customers by cutting prices in a choppy macro backdrop. So far, this has been a home run strategy. That stock up by 3.2%. Let's stick with the automakers. Ed mentioned this. Ford slashing prices on their own EV pickup truck. The company saying this: we've continued working in the background to improve accessibility and affordability to help lower prices and shorten wait times. Katie has more. Hey, Katie.
Hey, John. Well, sure, it's taking a hit off the heels of that news that they're going to cut the prices of those F-150 Lightnings. Of course, that's the EV version of the classic F-150 truck. So prices for all versions set to drop by at least $6,000. The biggest price cut on the Pro model comes in at nearly $10,000. Now, for the why, they said that this really comes back to improving costs, like you mentioned, and also increased plant capacity. For example, if you look at their plant in Michigan, it's been closed to complete upgrades that should triple its annual run rate to 150,000 Lightning trucks. And of course, John, this move also comes after Ford had increased the Lightning prices several times in 2021. So with these price cuts, Ford says that the MSRP should be closer to those initial Lightning prices. So shares currently off, though, about 4%, though I would note that Ford is up about 25% so far this year.
What isn't up this year, Katie? Pretty much everything's up, including the bond market over the last week. Katie, thank you on the latest. It's quite a run across the board here. We talk about the dominance of big tech, but you look elsewhere and there's some decent gains to be found. Talked about the airlines a few times already over the last month or so. American, United, Delta slightly positive in this session on the year. Up more than slightly positive, up more than 40% almost across the board. United this morning and its pilots agreeing in principle to a new labour deal. The company writing, quote, "We'll deliver a meaningful pay rise and quality of life improvements for our pilots while putting the airline on track to achieve its incredible potential." George Ferguson of Bloomberg Intelligence joins us now for more. George, what's it going to cost them?
So, sorry, I don't have it right at hand, but they're going to get a deal that's very similar to Delta. It's going to be probably 18% pay raises initially, retroactive, I imagine, to the beginning of this year, another 5% at year end, and then a 5% year after that, 4% year after that, 4% year after that, plus, again, whatever changes they have to quality of life, which are kind of rules changes at the airline, which will probably cost productivity.
George, I'm going to ask this as a consumer who's faced higher fares over the last few years. Does this mean eventually we're going to see better capacity?
I mean, it's going to help, I think, that the large U.S. full-service carriers pull in more pilots. But there are only so many pilots in the marketplace, and we're having a real challenge, I think, finding people that want to come to this industry, become pilots. And so for the broader, for the economy, I don't think it does necessarily get you more capacity. It may take years as we attract more people to the industry. My guess is what it means is other parts of the industry suffer from more shortage. Regionals are going to be challenged. The fractional, net jets kind of folks, they're going to be challenged. Some of the low-cost carriers are going to be challenged to recruit because of the higher pay rates at the big airlines.
George, I want to talk to you about spend as well. We heard from Delta a little bit earlier on in the last week or so. American Airlines coming up later this week with earnings. What are you looking for from American and United, for that matter, after what you heard from Delta?
Yeah, Delta showed, I thought, some very nice earnings, a lot of strength going into Europe. And so I would expect that will ripple through United and American as well, right? I think every American that needs to get back to Europe, I guess, hasn't been there in 3 or 4 years, and they're going to pay whatever it takes. I saw sort of 17% increases in yields there. Domestic was 0, it was flat. And so we feel like maybe the pandemic bounce could be over here in the States. Sort of domestically. And so I guess we're going to watch that very closely, right? Because it feels like the last couple summers have been marked by leisure travel. Again, leisure passengers really willing to pay almost anything it takes to get away on a nice vacation. The question is, can you extrapolate that into 2024? I'm not sure that bounce persists, especially if the economy slows a little bit. And we keep watching closely business. It's not fully back. We kind of see between 65 and 75% back. These airlines will need that business traveler as they get into Q4 and Q1. So we're watching that closely, too, for signs in the earnings.
Some big questions there, George. I think we're all asking. George Ferguson, thank you, including on the pain that so many of us have felt with that transatlantic cost over the last few years. Let's get to that consumer in America. There's just this growing chorus of cautious optimism around the consumer coming out of the C-suite in the last week. JP Morgan's Jamie Dimon saying this: the consumer is in good shape. James Fraser of Citi saying we see the US consumer as resilient. I think quote of the last week actually came from the Delta CEO, Ed Bastian. Air travel demand is strong and the consumer is in good financial shape. The growth is going to continue. Joanne Feeney of Advisors Capital Management joins us now for more. Joanne, let's talk about that. It's one of the top quotes of the last week for me. It just came from Ed Bastian, who is incredibly optimistic and constructive on the outlook for growth. There is significant growth yet ahead. He said flying is the #1 priority for discretionary spending. Joanne, do you think that can hold up?
You know, John, I think, as you recall, I've been talking about this for quite a while. The consumer has been strong, and for good reason. Not only did they have a lot of savings coming out of the pandemic, but more and more of them are getting employed. We're seeing that labor force participation rise. Even as inflation was eating away at nominal wages, more people getting employed means there's more in aggregate in the U.S. for consumers to spend. And so it does seem to be the case that consumers are likely to remain strong. There are pockets, though, where inflation has taken a bigger hit at a consumer budget. And that's why we think it's important to be careful about which sort of consumer stocks you want to own right now.
Well, Joanne, let's talk more about that. The trade-offs the consumer is willing to make. Clearly, they're not willing to give up some of their travel this summer. What are they giving up?
Right. Well, you know, if you look at how retail spending has changed, right, we're seeing that shift towards travel. We're seeing that shift towards leisure. But we're also seeing some, on the margins, some savings, you know, whether it's a smaller bundle that they're buying from, you know, the retail stores. They're switching more to essentials so that they can save money for the travel. And that's really been the story of this economy. It hasn't been a slowdown everywhere. As you just described, we've had growth, pretty substantial growth in various leisure and travel sections, while we've seen people stop buying new cell phones and new computers. They've saved money that way.
Rick Reeder of BlackRock spoke to my colleague at Bloomberg, several of them actually, and said, I just think a recession is grossly overstated. I think that plays into everything you've just said, Joanne. As a phenomenon today, without some massive shock to the system. We caught up with Andrew Slimmer of Morgan Stanley last week. We caught up with Jay Pawlowski of TPW. Joanne, both of those individuals said, for those of you sitting in cash right now, the pain that's been building over the last 6 months, not because you haven't got enough from cash, you've had 5%, you've just had so much more from equities from elsewhere. They think that money is going to come into the equity market. Joanne, I wonder if, one, you feel the same way about that, and two, if you have any ideas on where you think that cash is going to go.
Well, you know, John, it's clear that people have been really cautious. And we've been cautious, too, in constructing our portfolios to build in some defensive positions on top of our growth positions. But I think that view is correct. We're starting to see that broadening of enthusiasm for equities. Obviously, the first part of the year was those Super 7, you know, tech and consumer stocks because of the recession fears that have dominated the rest of the market. And as those fears abate, what they seem like they're doing, we do think there's going to be more enthusiasm for equities. We keep pushing out any recession forecast. It just keeps getting later and later. The continued strength of the job market gives us confidence that if there's a recession, it's not going to be until next year. But right now, it's sort of an open question because the consumer remains strong and the labor market remains relatively strong. We do think, though, some of that cash that's on the sidelines that has taken advantage of those high yields will come back into equities and take advantage of some very attractive valuations. Once you get out of that Super 7 that's trading at 40 times, you're looking at stocks trading at 15 times.
Are they the cyclicals? Are they elsewhere? Joanne, where are they?
You know, some of them are, John, but some are just structural growth out of healthcare. Healthcare hasn't really been treated with a lot of enthusiasm this year because they've done well before that. So there's opportunities in, you know, Pfizer or Johnson & Johnson, very high quality companies, relatively diversified in their pipeline of new drugs. Or you can look at industrials, you know, the Honeywells, the Caterpillars, companies, by the way, that are becoming and enabling their customers to become more efficient. I'm going to say those words, AI, you know, artificial intelligence will start to infect and raise productivity in lots of different parts of the economy. Industrials actually is one place to look. Logistics, a company like GXO Logistics, enabling their customers to become more cost effective, I think is going to be a big trend going forward.
Joanne Feeney of Advisors Capital Management. Joanne, thank you as always. About 14, let's call it 15 minutes into the session. Equities just about unchanged on the S&P 500. On the Nasdaq, positive by 0.3%. Coming up, looking ahead to more bank earnings.
This was a good quarter. We thought this would be the trough of the investment banking cycle, and we are seeing green shoots. The strength of the consumer and commercial loan activity is very promising, and size matters here.
Bank of America, Morgan Stanley reporting tomorrow, plus results from the regional banks on deck. That conversation up next.
these companies are very profitable, even with higher credit costs. It's very encouraging when you see numbers like this. If we go into a soft landing, this profitability for the group is going to remain very strong.
Earnings season kicking off last week with the big banks JP Morgan, Citi, Wells reporting better than expected results. Still more to come. Bank of America, Morgan Stanley report tomorrow, Goldman on Wednesday, and regional banks throughout the week. Let's get to the team coverage. Sonali Basak, Katie Greifeld join us now. Sonali, the big banks pick it up again tomorrow morning.
They sure are. I want to remind you what happened on Friday, though. You had a lot of positive numbers coming out from three major banks. By the end of the day, two of those three banks were in negative territory on the day. And it's because even if they're lifting net interest income guidance, they have cost pressures everywhere else. Tomorrow with Bank of America, you're going to want to see if that net interest income comes in just as hot as JP Morgan is expecting for the year. But in addition to costs tied to loans that are starting to sour, you're also worried about things like severance costs and other costs that have risen pretty meaningfully over the last year as bankers are getting back across the world traveling to get deals done, and that deal pressure is under pressure still for potentially the rest of the year. Over at Morgan Stanley, it's not just about the numbers, John. You know that there's a succession plan underway. And so people will be looking to James Gorman to see what the future of Morgan Stanley looks like after him. So a little bit of big picture for the banks. Goldman, by the way, Wednesday, you can't take your eyes off that. There's an expected $2 billion worth of write-downs tied to Green Sky and the commercial real estate books. So the next couple days we'll be parsing through the numbers pretty closely. But as Mike Mayo keeps saying, Goliath is winning. The bigger getting bigger. That is pretty clear from the earnings picture so far.
At the expense of who? Katie Greifeld.
Well, for the regional banks, it's all about deposits and how much these lenders are having to pay to keep them. Of course, that's as depositors seek out a greater share of the Fed's rate hikes elsewhere. Of course, we learned on Friday that those interest expenses are a problem for the big banks. Of course, it's expected to be an issue for the smaller banks as well. And that should translate into a hit into net interest income. Some of these regionals have already warned that that's coming. KeyCorp, for example, it's warned that deposit pricing pressures should drag net interest income down by 12% this quarter. Then you take a look at Zions. They also expect their net interest margin to fall. So expect that to be a theme. Of course, we'll learn more tomorrow when we have the likes of Western Alliance kicking us off. I believe Fifth Third, Truist, and you can see the list there, also expected to take the stage this week.
Let's stay on that list. Sonali, 2 months ago, this is all we were talking about. What happened?
We're still talking about it, John. We're not out of the clear yet. If you talk to a bond trader, for example, there's still a huge discrepancy on whether you want to buy bonds of regional banks that have sold off. If you take a look at that list that Katie was talking about, First Horizon is down 50% on the year. KeyCorp down 41%. Zions 37%. As we hit midway into the year, knowing these pressures are ahead, have they sold off enough? The KBW Bank Index only has about 5 banks in the green, and all of them are big banks. Thursday, I will also say, is Capital One, up 20% this year. Do they deserve that, or are loans souring faster than expected? I think that is a critical question as we think about credit quality moving into the rest of the year.
Interesting coverage, guys. Just setting the stage for the financials later this week. Sonali Basak, Katie Greifeld, looking forward to the coverage from both of you over the next couple of days. It commences again with Morgan Stanley and Bank of America coming up very shortly tomorrow morning. Then on to Goldman. They've set the bar so low going into Wednesday. Look out for Goldman Sachs on Wednesday morning. More broadly for the market right here, right now, 22 minutes into the session, unchanged on the S&P, on the Nasdaq up by 0.2 with some sector price action. Here's Abby.
And it's pretty evenly split at this point right now with the S&P 500 fluctuating, John. Up top, we have the financials up about 0.6%, followed by industrials, consumer discretionaries. We have some of the defensive sectors on bottom, both healthcare and utilities. Utilities down despite the dividends looking probably a little bit more attractive than yields down. As for the year, let's take a look at the big divide here between tech and the banks. It's really pretty interesting. Tech, the best sector on the year, up 44%. Financials, well, it's a lot better than it had been about 2 months ago. At this point, we do have the S&P 500 financials up ever so slightly as this recovery you guys are talking about seems to be occurring, John.
Pretty brutal divergence. Abby, thanks for that. Coming up, we'll run you through what you need to work for through the next couple of days. No Fed speak. Bear in mind, the Fed is in a quiet period, so you get no Fed speak until next week when we get the Fed decision next Wednesday. A sprinkle of economic data. I'll bring you the trading diary up next. 25 minutes into the session, we're doing okay here, up by 0.05% on the S&P. On the Nasdaq, slightly firmer, positive, higher, up by, let's call it 0.1% on the Nasdaq 100 this morning. That's the price action. Let me run you through the trading diary. I mentioned briefly a little bit earlier, no Fed speak. They're in the quiet period ahead of the decision next week. We do get some data, though. It starts with retail sales coming up tomorrow morning. Look out for that, plus earnings from Bank of America and Morgan Stanley ahead of the opening bell. Goldman Sachs setting the bar very low. They report on Wednesday, plus we get results from Tesla and Netflix. Look out for coverage on that the following day. And another round of jobless claims coming up on Thursday. Then we wrap up the week with Q2 results from American Express. From New York City, that does it for me to kick off the trading week. Thank you very much for choosing Bloomberg TV, and good luck for the rest of the trading day and the rest of the trading week. This was the countdown to the open. This is Bloomberg.